The Money Show.
Personal Finance with Warren Ingram.
But tonight we're talking about your credit score, why it matters, how to improve it. And I suppose, Warren Ingram, good evening. We should start with what it is. Warren, of course, is a certified financial planner at Galileo Capital. Warren, do most of us actually, if we're involved in the economy in some way, if we have credit, do we have a credit score?
We do, and even if we don't know about it, certainly the people who give credit and with whom we've got accounts will know us very well, and they'll be tracking and monitoring us. But, Big Brother is alive and well in the world of credit, Stephen.
Okay, how does it work? I mean, what is it exactly? How is it sort of made up?
So you get a score. And depending on which credit union or credit scoring agency is giving you the score, it ranges from a number, from 0 to 999. And the lower the number, the worse your score is, and the higher the number, the better. And better in this instance means that you will seem more creditworthy to the people who are going to want to lend you money. So let's say with the scoring system of 999, if you've got a score of around 650, that's a bit different to school because 650 is kind of a pass mark. It's like you're just okay. But the closer you get to 900, the better. And so when you apply, let's say for any kind of a loan, whether it's a home loan or a credit card or something like that, one of the things that will happen is that business that's looking to give you the loan will check your credit worthiness, and the higher the score, the more chance you'll get of, or the greater the chance of actually getting a loan. And for something like a home loan, the more likely that you get a better rate of interest, which really helps a lot.
Okay, when they look at the credit score, is it a sort of automatic process? I mean, can someone give me a bad credit rating because a bad credit score because they don't like me?
No. So this is quite well regulated, Stephen. I think in the past there was some pretty bad behavior by credit providers where they would kind of just mark you off as a bad debtor, and you wouldn't have much of a chance. But now it is well regulated, and so the way that the scoring works is based on a few factors. So one of them is how well you pay off your account. So if you're expected, let's just use a credit card as an example. If you're expected to pay off, 5,000 Rand a month on your credit card debt, and you do that every single month, for a couple of years in a row, that will count in your favor a lot. But equally, they'll look at something like the ability for you to manage your credit. So if you're offered, 100,000 Rand credit card facility, but you're only using 30,000 Rand of that facility, and you do that fairly consistently as well, then that will count in your favor because you're not using the maximum all the time. And then one which I think a lot of people don't really know so much is how long you've had that facility. So, for example, if you got a credit card, just after you started work, and 20 years in, you're thinking of canceling the card because another company is offering you a few more benefits, a few more smoothies or whatever it is, just be careful because the length of time that you've had an account that has given you credit does count a lot in your favor. And then lastly, which is one you just need to be very careful of, is how many new credit applications you've made in a short period of time. So if you're applying for 4 or 5 different loans from different institutions over a 5 or 6 month period, that's going to count against you because it looks like you're in financial distress and you're trying to get as much credit as you can all over the place.
Okay, so I just want to understand this a little bit, if I may. I understand that if I have been borrowing money, so if, for example, I have a regular bill that comes from my cell phone company and I pay that on a regular basis, or I don't, or whatever, I can understand them sending the information through to the credit bureau in the form of a score. Fine. But in terms of how much credit I have available, that means my bank is telling them that I'm using on a regular basis between 30% or 90% of the credit that I have available, and I'm the customer of the bank, sure, but doesn't that mean they're passing on some information about me?
I think it's done in a very controlled way, and it is an integral part of the financial system, because if we don't have a way for credit providers to understand the risk of the person they're taking on, then all of a sudden either they don't lend money, or they lend to the whole market at a much higher rate of interest, because they can't price the risk that they're taking from their individual clients more accurately. So it helps to make the credit market more efficient in a way where each of us can be weighted, I guess, on our individual merits, rather than being categorized, as unknown and almost uninsurable in a way, but actually unlendable. But that's not a word.
Sure. Okay. No, that does make sense. All right. If you have a poor credit score, and I can imagine how and why most of us probably do, how does that cost us? What happens?
So I mean, very practically, that you actually might be considered too risky. So if your credit score is horrible, you might find that you decide that you want to buy the house of your dreams. You apply to a bank, and a bank says, nope, unfortunately, we don't think that you're a safe risk. So we're going to decline the loan altogether, and that could apply to anything, whether it's getting a credit on a credit card, or car finance, or anything where you are going to have to take on risks, or someone's going to have to take on risk on your behalf. So I think it could be really bad in terms of they just say nothing, we're not giving you anything, or they say, you're extremely high risk, so yes, we'll lend you money, but we're going to charge you a very high rate of interest because we're taking on a lot more risk. And you often see that in the world of vehicle finance, where you see interest rates at prime plus quite a few percent, and that's because the financier believes that the risk they're taking is very high, and they don't necessarily want, if they're a vehicle financier, they don't really want to end up owning a bunch of cars, that they want to get paid back the money. So that will be a real consequence, is that you've got a lousy credit score, and so you pay a lot more interest. And that becomes quite a slippery slope, because then all of a sudden you're spending more of your disposable income just on servicing interest and not paying down the debt. So yes, it does affect things like whether you can get debt and then the interest. And then, more broadly, if you want to get contracts, for example, a cell phone contract, you might find that, company says, sorry, we're not giving you a contract. You're going to have to do pay as you go because of your credit score. And then I think this is not as big an issue, but certainly in some industries, where they want to employ people, that they'll need to know that those employees of theirs are credit worthy. And you can imagine people who deal in large sums of money on behalf of clients. You would want to know that they're not a financial risk, potentially a fraud risk or something like that.
We're taking your questions for Warren Ingram: how to improve your credit score, how to manage your credit score, the impact it has on you. 011 883 0702 021 446 0567. Voice notes as well on 072 702 1702. It's 16 minutes now to 8 the time. Okay. So what are the habits that hurt our scores, Warren? What sort of gets us into the negative? What brings it down from the kind of mythical 900 level?
So paying your debts on time is not like, deciding to go to gym, where sometimes you go and sometimes you don't, and, you skip a payment here or there, and you think that everything's fine because you make it up the following month. Every single time you miss a payment, by the appointed date. So if you're supposed to pay for debt by the end of the month, and you pay it 5 days late or 60 days late, that's counting against you. And I think it's probably one of the biggest weighted factors against you. So if you do this quite consistently, it's going to have a very big impact on your credit score. And if you miss quite a few payments, then all of a sudden, you might be handed over as now a bad debt, and suddenly, a legal debt collector is going to be on your case, and that's really bad for you. So I think that that's probably the first big one. But equally, as we kind of just chatted about as well, is that if you're if you're using all of your credit facilities or the bulk of your credit facilities all the time, it's not going to help your credit score. So it's important to know that, if you've got, credit limit, and again, let's use that example of, 100,000 and you're only using 30 or 40,000 of that, and then paying it down to zero again, that's very good for you. So be careful of using all of your facilities thinking that, you're okay. You're not. And so I think, and then the last one for me is around this multiple credit products in a short space of time. A lot of people would, kind of apply for a new credit card because a new bank launches, or they think, that some or other bank is offering a new, value added service that they really like. And so they apply for credit and not realizing that, suddenly the credit ratings, or your personal credit rating or your credit score is just getting compromised all the time. So I think that those are probably the big ones, Stephen.
Yeah, no, I mean, it's very interesting because obviously you want to just use you want to get a deeper understanding of this. We've got a question from Younger in Johannesburg. Younger, good evening. You're on the line with Warren Ingram.
Yes, how are you, sir?
I'm well, Younger, go for it.
Yes, so my question is, if they can see that someone is already they're struggling to pay because of a low credit score, why then request much more from them? It doesn't make sense, because I'm already struggling, but I want something, and you asking more from me. Shouldn't it be vice versa?
In other words, because it's tougher for you, they should make it easier.
Yes, they can see that I'm struggling, but I want something, I'm applying for it. So, and then you think because you have a bad credit score, we're going to give you a higher interest. And that means that someone else who has in a better financial position, maybe they're paying 5,000, but you are asking now 7,000 from me, while you can see I'm struggling. It doesn't make sense.
Younger in Johannesburg, thank you. Warren, I suppose the question boils down to risk for the lenders.
It's exactly that. So I mean, I think this isn't a protect the bank show, but just to explain that, if you're going to lend to someone, let's just say you decide on your own to kind of start your own little mini bank, and you've got two people that come to ask if they can borrow money from you, and the one person has a very good history, you've known them a long time, and they always pay their debts off on time. That's a client that you want, because you can lend the money and you've got a fairly kind of good idea that they're going to pay you back. So you're going to entice them to become your client, number one. And number two, you're going to try and lend to them on the best rates possible, because you want them to not shop around at other banks and get the money elsewhere. So that's exactly the client that a lender wants. But then you've got the other person who comes along and says, look, I haven't really paid very well for the last while. Things have been tough, but this time it's going to be different. I'm going to be okay. Please lend me some money. Now, the lender wants to be sure that they're going to get their money back, number one. But number two, they also want to be paid for the risk that they're taking. If that person that's borrowed money from them then doesn't pay it back, then the lender's lost the capital amount that they've lent and the interest that they were supposed to earn. And now they've got to go through the legal route of trying to get the money back, etc. So for someone lending money to a client, they want to entice clients, the good clients with low interest rates, and then they want to be paid a rate of interest that's commensurate with the risk that they're taking. So I understand Younger's point. It seems unfair that the person in trouble is being punished, but equally, the point is lenders don't have to lend. They're lending as a business, and they are going to say we need to be rewarded for the risk we're taking.
Yeah, it's tough out there, Younger, and I think you're asking a question that many people are thinking about. Just before we go to the break, at Solo in Ferndale, hi.
Hi, Stephen. My question is on how to build my credit record. I'm a freelancer and I have a property which I bought cash, and now I want to invest and buy a second property, but I've never had any credit, never had any store accounts, and now I want to kind of start building that record in order to get financing for a second property.
Yeah, you're actually in quite a strong financial position. The banks just don't see it. So I hope you don't mind. I'm going to ask if you wouldn't mind listening to the answer on the radio. We're going to have an answer for you about that from Warren in just a moment.
The Money Show. Personal finance with Warren Ingram.
8 minutes to 8, and just before the break, Warren, we heard the question from Tsolo in Ferndale. It's a really good question. How do you build a good credit score when you've bought a house cash, you're a freelancer, you haven't really borrowed money before, now you want to borrow money to invest? So Tsolo's really in quite a strong financial position. The bank just doesn't see it, Warren.
Yeah, this is the exact perfect client for lenders, and it's the one where the whole credit scoring system is, I think, has a huge flaw. It's one that really frustrates me, because all of the things we'd be saying to people all the time is, be careful of debt, avoid debt, pay cash, etc., etc. Here's the perfect person with the perfect discipline, and now they don't have a ability to get a credit score. So the answer is, maybe if you are a freelancer, it's going to be hard to show salary, but you have got an asset. You've got a paid off house. And certainly you should be able to get at least a very small, a debt facility where you can use the house as surety to then build up a bit of a credit score over time. So you could say, for example, give me a small mortgage on the house if you can. If the house is worth 500,000, give me 50,000, and so you use that facility as one way. Or talking to the bank to show them your asset, and then saying, give me a credit card, even though I'm a freelancer, I have got a history of earning money, I do earn rent, etc., etc. And then give me a small credit facility on a credit card. You can see the assets I've got. So they do like the fact that someone has assets, but you're going to have to jump through some hoops before convincing the bank to lend you some money, unfortunately.
Yeah, sort of strange and unfair. Okay, you've got a score. You might not know what it is. Are we allowed to know what our credit score is, by the way? We should be.
Yeah, it's one of the things that is regulated, that we can go to the credit bureaus and ask them to give us our credit score, and we're entitled to ask for that as a free service once a year from each of the credit bureaus. So certainly you can, and it's absolutely worth doing. If you are in the market to get some debt, to know where you are and to see how you can then improve your credit score.
Okay, so now you have your credit score. You're not happy with it. You want to improve it. What do you do? How do you start to really build that up? And obviously it won't happen immediately, but where do you begin?
Yeah, I think to understand that credit scores are not like a kind of a lifetime thing where you've got a bad mark and it stays with you forever. So it does work over 12 and 24-month periods. So if you start to pay off your all of your accounts that you have, and you do it every single month on time or ahead of schedule, and you do it without any interruptions, and you do that consistently for at least a year, but preferably 2, you'll find that your credit score will definitely start to improve. So I think that sort of discipline over time, showing them that you can pay your facilities is very important. And secondly, when you do get your credit score from a credit bureau, and you look at what the score is, it's important to go through that report that you get along with your credit score to see if there is not some mistakes on that. Sometimes you're shown as having an account open that you actually never had, or some kind of a judgment that was put against you which should have been removed a long time ago. So make sure that you check all of the information, make sure that it's correct, and if there is something wrong, you have the legal right to dispute that information. And if you win that dispute, then that will have a huge impact on improving your credit score very quickly.
People do make mistakes. It actually happened to me once, where a provider, someone I'd been paying regularly, just missed a payment that I had made, and that had an impact. It's worth going to check, because you never know the impact it'll actually have.
Especially where those those payments aren't automated. So, for example, if you decide to pay an extra amount in and it's done as a manual process, it is something that can be missed. And especially if you're doing your part, where you're paying the minimum that's required of you every month, and then every now and then you do a top-up payment, and then they miss the top-up payment, and you think everything's done, but according to the provider, you owe money and you're not told about it. So it does happen, and it really is worth checking your records and make sure. And equally, you can't just dispute everything for the sake of it. You need to be very sure that there is a mistake before you go and challenge it.
Warren, we do have a couple of moments left, and we were talking about medical aids earlier on the program. We've got a question from Marissa saying, I'm 71. My medical aid premiums have become my single biggest monthly expense. Every year, the increases outpaces my annuity income, so I'm going backwards. I'm scared to downgrade my plan in case something serious happens, but I can't keep absorbing these hikes. What can I do to improve my situation? And when you look at medical aid inflation, I can completely understand Marissa's position.
Yeah, it's my absolute nightmare question. Retirees who started fairly comfortably and thought everything would be good with their planning, then get caught, over a number of years with just medical aid rates accelerating at a much faster rate than inflation. And unfortunately, as we get older, and the need for medical aid increases. So it's a very tricky situation, and I think Marissa's point around being very careful to downgrade a plan is real in this instance. So I would say it's important to understand, what the benefits are that you're paying for, and making sure that, if you're looking at changing plans, make sure that you're not changing to a position where you might save yourself a little bit of money on a monthly basis on a premium, but suddenly you're in a lot worse position because not all of the expenses that you have are now covered by your replacement medical plan. So I think, number one, just to understand what it is that you're paying for, and also what are you using. And sometimes there might be some benefits that you're paying for that are useless. But I would be very careful to downgrade my plan. I agree, Marissa. I think you've got to make some sacrifices elsewhere.
Warren Ingram, thank you very much indeed. Certified financial planner.